What's going on, guys? In today's video, we're talking about Adobe. Now, they're going to be reporting their earnings on September 14th. Obviously, this video is coming out beforehand, but it's going to give you just a little bit of a preface to figure out what this company is doing right and what they're doing wrong. And then afterwards, we will find the intrinsic value of this business, so you'll know if you're getting this company for a good deal or not. Because when earnings seasons comes along, here's what happens. A lot of people either overreact or underreact based off how well the company's been performing. So Adobe over the last little while has actually been performing pretty well, and I'll bring you into the stock spec software here to show you what's going on. But it's had a bit of a run up, as you can see here by the charts here. I'll zoom in, but basically, it was on a massive decline for pretty much all of 2022, and now it's starting to turn itself around for 2023. Now, currently, we are sitting at $558.41 for the price. It hit a high of, in the last 52 weeks, of $570 and a low of $274, so quite a big gap here. But we are currently not at the highs that were experienced back in 2021. It's been a very interesting ride for this company. So if you're looking to get into this business or invest into this company, you've come to the right place. My name is Leo. I'm a value investor. So what I like to try to do, folks, is find great businesses at great prices. Now, is this the price to buy Adobe at? Well, we're going to find out right now. So the software I like to use is obviously called StockSpec. You can follow it at stockspec.com, the 7-day free trial. And what this software does is pretty much gets all the financial information of a company and then grades it out of 10, along with giving you the tools to compare the trailing 12 months to the 5-year trends that the business has been performing at, along with a price analysis section so you can find that intrinsic value, along with many other great features like 10 years of financial data in their balance sheets, cash flow statements, as well as some charts. Anyways, apart from that, Adobe's sitting pretty comfortably at an 8 out of 10 score here, as we see here in the financial valuations. They're only getting docked in two categories. One being the price to earnings ratio sitting at 47.37 on average, which indicates to us that that's a pretty high premium to pay for this business. We want to find companies that are below 22.5. That is more of a fair number, because ultimately it comes down to how much are you willing to pay for $1 of earnings. If you're able to pay $22 versus $47, $22 seems a lot more fairer. Obviously, that's still a bit high, but 22 is a lot more approachable than 47. Next, they're getting docked in their current ratio, which is sitting at 1.16. Ultimately, folks, we like to find companies that have a current ratio of 1.5 and higher. Now, that indicates to us is that, do they have enough assets on hand to cover liabilities? When things get shaky and they have to liquefy and their positions in certain things, can they cover those liabilities? 1.5 is a healthy ratio, because that indicates to us they have enough assets to liabilities, plus that 0.5 has a little bit of a margin of safety, and they are in a much more safer position. 1.16, not the worst. It's just not ideal, and we like to find companies that give us the most margin of safety for those what if scenarios. So they're getting docked in those 2 points, not the best. However, they are doing a lot of other things right. They have a great return on equity average sitting at 32%, which is great, because that's incredibly high, and if that's the trend and it's very stable, we love to see that. The EPS growth is up by almost 1,000% over the last 5 years, and couple that with a low debt to equity ratio, you are laughing if you've been holding the stock up until this point. So this video is obviously for people that are looking to buy Adobe, but also if you have been holding Adobe stock, this is just to reaffirm your belief in the company, because I'll tell you right now where it currently stands. And basically, I love seeing a low debt to equity. It's super important, as well as you couple that in with the next category being their share dilution, sitting at negative 1.47%, which is great. That means they're taking the amount of shares outstanding and decreased it. So you as a shareholder technically own a little bit more of the company, because now there's less pieces of the pie to share, and this is where you want to be. Now, the net income is up, the free cash flow is up, and the revenue growth is up as well. The trifecta of a successful business. These are three things you definitely want to see, as well as a 5-year return on invested capital average sitting at 23.66%. Massively high. That means it takes less to actually reinvest into this business to grow the business. That means they are incredibly efficient, and they should be. Think about it, like they run the industry standard for pretty much everything creative, from Adobe, Photoshop, Illustrator, Premiere. Everyone across any kind of arts medium is using their software. And now I think their new Photoshop has AI built into it, and it's made its run on different memes and stuff like that. And essentially, if you get into the meme culture, you're essentially blowing up like crazy. But I mean, apart from all the jokes aside, they're just phenomenal software, and I haven't seen anything break through the moat that they have essentially created. Like, it's just they're the go-to for anything creative. Now, apart from that, so the numbers are looking pretty good. They also have a really good Altman Z-score. And if you don't know what the Altman Z-score is, this just indicates how safe a business is from going bankrupt. 13.49 is a phenomenal number. Anything above 3, folks, is what you're looking at. 1.8 to 3 means that the company's in a gray zone. And anything that's 1.8 and below means the company's in distress. So it being at 13.50, essentially, this means that this company has phenomenal financial strength, and it's not going to go bankrupt anytime soon. Now, what are some other things that stand out? Free cash flow on average for the 5 years has been $5.5 billion. Currently, we're sitting at $7.42 billion, so we're up from the 5-year average. That's phenomenal. The only thing that's a little bit griping is that the price earnings ratio is above the trend. So as I said earlier, the 5-year price earnings ratio is trading at a premium, and currently we are higher than the trend premium. Something we don't want to see. But here's the other thing. With that going up, our EPS is higher than our 5-year average. Our return on equity is higher than our 5-year average. But our profit margin is slightly lower. But ultimately, this is a little bit of a gripe, because that means we are paying a premium for this business. It's tech, and here's the thing with tech companies. It's very rare you find them at a discount, and I guarantee, possibly, I've done analysis on this company some time ago, but I guarantee that discount might have been right here, September, pretty much a year ago. A year ago, that is where that sweet zone probably would have been, somewhere probably within this bracket, within this price range here. But now we're swinging up. So what does that mean for us new investors? Well, I put some numbers in here in the price analysis section. And before we jump into this, if you found this video helpful so far, hit that like button and subscribe button. It means a lot to me, it means a lot to the channel. I'm going to show you this next section, which I think is super important. Now, this section here allows me to put what I believe the company's going to do over the next 1 to 20 years. I personally choose 10 years because I feel like that's a safe 7 to 10 years is pretty much a safe numeric to look at for how long I believe I'm going to hold this company for if I were to invest in it. And utilizing the historic averages that they've shown in the past, I've plugged in those numbers. Now, here's the thing, folks. Past performance isn't indicative of future performance, right? But we can learn from those trends and figure out, okay, if I take, let's say in the last year, the revenue grew by 11%, and I discount that, and I say I'm gonna chop off, give it a haircut, and say, well, you know what? Maybe going forward, it's only gonna grow 7%, and it's worse. That I think they're gonna grow worse than what they've currently done, and they beat my expectations. I'm giving myself a proper margin of safety, so I know that if I do eventually buy this company, I'm getting it for a really good deal. So that's what I'm doing for those who are extremely new to this. So I've said with Adobe, I think it's going to do worse growth based on what they've done in the past. So I said 7, 8, and 9%, worse profit margin, doing 22, 23, and 24. And free cash flow margin, same thing, because they've done 35% here, and I'm only doing 30, 31, 32. And with the price to free cash flow and price earnings ratio, we want to stay below 20. That is my go-to prerogative, and that is more of a fair value multiple. So here it's 34, here it's 52. So I'm doing 14, 16, and 18. Extremely low than what has ever been in this company, along with a desired return of 13%. Now, the market returns about 10% a year if you just hold your money into the S&P 500 index fund. So if you are going to probably, let's say, potentially buy an individual stock, I think it only makes sense to give yourself just a higher return. And if you follow other channels like Everything Money, and Paul says the same thing, and I agree with him, because look, if you're going to go and isolate your position into something as focused as, let's say, one company, you're putting your chips on the table pretty heavily. So you might as well bet big to earn big, right? So 13% return, let's see what that comes out to be. I'm going to click calculate. It's going to chug away at all these numbers and all these calculations. Current price, $5.58, and it's going to find out what we should be paying for this company today. There we go. Okay, so take a look at this, folks. All right, average calculation comes out to be 276.14, and on the low end 217, and the high end 337.57, and moderate average of 273.82. So what does that indicate to us, folks? Currently, Adobe is quite overvalued. However, we were at that range, 276, the 52-week low. That was pretty much, what was I saying? Right here, literally right here. When it dropped down last year to hit those marks of pretty much of 277, that is where Adobe was trading at fair value. So essentially, if we're able to get this company below 276, or listen, you might think I'm way too conservative, and you might think it's, hey, Leo, I think it's probably in here. Let's say split the difference below $300. It's a huge drop still, nonetheless. That is where Adobe becomes interesting and potentially a buy. I mean, it was kind of evident based off the price earnings ratio. Not saying that that is the only metric to take a look at. However, you are buying it for a premium based off the earnings that are coming in. So what do I think? Currently, Adobe needs to drop by at least 50% for it to make sense to buy in. Now, you might think, well, it's already, everything's priced in. Why not buy into this company? Yeah, but here's where the market doesn't make sense, right? If that's the case, then it wouldn't have dropped as much as it did. But here's the market never makes sense, and it's up to us to try to find those discrepancies. So right here, look at that sharp drop down. You telling me it lost that much value overnight? No, this is where smart investors would have possibly got in. Now, I probably missed the boat on that. I have to look at my other analysis videos, but look, based off what the numerics that I've brought forward today, this may have made sense. Now, what am I going to do? I'm going to put a little marker and put a just a price watch and see if this thing hits below $300. And then I'll eventually revisit this company. And here's the thing, folks, with value investing in any kind of company analysis, obviously numerics change. Obviously more information comes out. Today, it's worth $276 to $300. Tomorrow, that number might change to $350 based off any other new information, if anything comes out. The important thing is to ultimately do more analysis as time goes on. But currently, I'm putting a metric to say, look, this thing hits $300, alert me, and I'll probably jump in. But I'll probably revisit this company maybe 6 months from now to see if that's still, if those numbers still make sense. But right now, Adobe, currently overvalued. I think it's a great business. I think they have a wide moat. It's just the price doesn't make sense. And that's unfortunate with a lot of businesses right now. There's a lot of great businesses out there, but the price just doesn't make sense. So folks, if you found this video helpful, hit that like button and subscribe button if you haven't. I do videos 3 times a week, hopefully, but I try to do as much analysis videos as I possibly can for you guys. Make sure you check out my other analysis videos because there's some gems in there that you don't want to miss. I will see you in the next one. Thank you so much for watching.